Welcome to Maple Leaf Money, a Canadian-born movement for financial clarity. We're here to simplify money, cut through the noise, and help you make informed choices that build confidence and stability over time. Let's grow your financial literacy one episode at a time. Today, we're continuing our journey through everyday banking in Canada, and we're tackling a question many people quietly wonder about, but rarely ask out loud. What's the difference between a bank and a credit union? And does it actually matter which one you choose? If you're a student, a young adult, or someone new to Canada, you may have opened your first account at a bank simply because that's what felt familiar. But banks aren't the only option, and understanding the difference gives you more control over your financial choices. So let's slow this down and talk it through clearly. At a surface level, banks and credit unions can feel very similar. Both allow you to open checking and savings accounts. Both offer debit cards, online banking, bill payments, loans, and mortgages. From day to day, the experience can look almost identical. The real differences don't show up in the basics. They show up in how these institutions are structured, who they serve, and how decisions are made. One of the biggest differences is ownership. Banks are owned by shareholders. These are investors who own shares in the bank, and the bank's profits are meant to benefit those shareholders. Credit unions are owned by their members. When you open an account at a credit union, you become a member, and in a small way, a part owner of the institution. This difference in ownership shapes almost everything else. Because banks are shareholder-owned, profits are typically paid out to shareholders or reinvested to grow the bank. Credit unions, on the other hand, often reinvest profits back into the organization itself. That can show up as lower fees, better interest rates, improved service, or support for local community initiatives. Neither model is right or wrong, they're simply designed with different priorities. This difference sometimes shows up when people compare fees and interest rates. Credit unions often aim to keep fees lower and policies simpler. Many people notice fewer penalty charges or more flexible terms. Banks may charge higher fees in some cases, but they also tend to offer a wider range of products, more locations across the country, and advanced digital tools. The key point here is not to assume, but to compare. Each institution sets its own fees and rates. Another difference is scale and focus. Credit unions are often community-based. Decisions may be made locally, and staff may have more flexibility to consider individual situations. Banks tend to operate nationally or internationally. Their policies are usually more standardized, but they also offer consistency and access across regions. Some people value the personal, relationship-based approach of a credit union. Others prefer the reach and convenience of a large bank. A common and very important question is about safety. Both banks and credit unions protect your deposits, but they do so through different systems. At banks, eligible deposits are protected by the Canada Deposit Insurance Corporation, often referred to as CDIC. This protection is free and automatic for eligible deposits at member banks. At credit unions, deposit protection is usually provided through provincial deposit insurance programs. In many provinces, this coverage is equal to or even greater than what is offered through CDIC. The important takeaway is this: both systems exist to protect depositors and maintain trust in the financial system. When it comes to technology and access, banks often lead in areas like mobile apps, international access, and large ATM networks. Credit unions may offer simpler digital tools, but often share ATM networks with other credit unions, so members can still access cash conveniently. Again, neither is universally better. It depends on how you prefer to bank. So how do you decide which one is right for you? A bank may be a good fit if you travel frequently, want access across the country, or value advanced digital features. A credit union may be a good fit if you value community connection, prefer lower fees, or want more personalized service. Some Canadians even choose to use both, a bank for certain services and a credit union for others. Here is today's closing reflection. Banks and credit unions exist for the same reason: to help people manage, protect, and move their money. The key difference lies in how they are structured and who they are designed to serve. When you understand those differences, you're no longer choosing out of habit or familiarity. You're choosing with intention. And that kind of understanding is a powerful part of financial confidence. Thanks for listening to Maple Leaf Money. Subscribe on Substack or wherever you get your podcasts, and join the movement to build stronger financial literacy across Canada. Until next time, stay informed, stay steady, and keep growing.